Friends, we are starting with a new concept, and the name of the new concept is efficient market hypothesis. That is the new concept with which we are going to start. Name of the concept is efficient market hypothesis. Let us have understanding of this. So the concept of efficient market hypothesis. Friends, basically, so this concept I have kept in the chapter of the portfolio management, but if at all you refer your module, it is not there in the chapter of the portfolio management. It is there in the chapter of the security analysis. However, that concept is very much connected with the portfolio management concept. That is the reason I have shifted it over here. That is what even I have told you even earlier, that many a times what I do, I keep the questions say in my material in such a way where I think that I would be able to relate it better. So going with the concept of the efficient market hypothesis. Friends, the term hypothesis stands for, say you believe in something, and that is what say we understand is we want to test, and it is called hypothesis. It means that say you want to test a situation, you want to make some experiment, and that is what say we understand is called hypothesis. So the hypothesis or the theory is that the market is efficient. Now what do we understand with the term the market is efficient? The market is efficient means that overall market is dealing in such a way so that no investor is able to earn supernormal profit from the market every time. It is not possible for you to beat the market every time. As an investor, if at all I think that let me take advantage of some news and with that I will be able to earn higher, it is not possible. Let me do some technical analysis with which I try to analyze the trend of the price of the security, and with that I would be able to make a gain. It is not possible. Why? Because the overall market is efficient. Whatever the information based on which I want to do a transaction in the stock market, that information has already been incorporated in the price of the security. I give you certain examples like this. Suppose, say there is a news in the market that this company is going to be acquired, say by another, like the large company. Another successful company is going to acquire this company. Let us say that there is a company which is doing very good in its business right now, and that company is fastly growing in the market. The news in the market is that the Reliance company is going to take over that company. And with that say, of course, I think that the price of that security will further increase. So I go to buy that investment. I go to buy that security. But by the time I go to buy that security, the price of the security has already been increased. So based on any information, it is not possible for me to earn supernormal profit from the market. If at all as an investor I think that say I will take less risk and I will be able to generate more return, then this theory says that it is not possible. Why? Because say overall market is efficient. All investors are always say constantly watching the market. They are constantly encashing. They constantly incorporate the recent information about the security in the price of the security. Now based on some past trend, if at all I think that say the price of the security will now increase, and based on that say buy the security, then in that case this theory says that say there are fair chances that say your prediction may come to be wrong. Reverse, you are expecting that say now the market of the price of the security will definitely fall down, then again this theory says that it is not possible that whatever you anticipate will come true immediately. Or it will come true at all. Say by luck it may happen, but every time you will not be able to say beat the market. That is what the theory says. The theory says that, listen carefully, there are like the three forms of the efficiency of the market. First one is given a name as weak form of efficiency. Another is given a name as semi-strong form of efficiency. And the last one is given a name as strong form of efficiency. There are three forms of efficient market. First is the weak form of efficient market. The second is semi-strong form of efficient market. And the third one is given a name as the strong form of efficient market. Listen carefully. As far as the weak form of efficient market is concerned, the theory says like this, that weak form of efficient market means a market in which, based on the past prices, it is not possible for you to predict the future prices. Friends, there is a concept called like the technical analysis that we understand, in which, say, based on the past trend, we are expecting that how the price of the security will now react, how the price of the security will change, whether the price of the security will now move up or now it will fall down. So that kind of some prediction is made. But the theory says that, say, based on the past prices, it is not possible for you to predict the future prices. That is the weak form of efficient market. What is semi-strong form of efficient market? It is the market in which, listen carefully, all public information are always incorporated in current price of the security. Listen carefully, what does this theory say? This theory says that basically whatever the information based on which you try to encash that information in the market, but that information is already incorporated in the price of the security. A company announces that it is going to pay dividend. So now you go to purchase that security, but the price of the security has already been increased with the present value of the dividend. If at all a company is, say, heavily penalized because of the violating of any law, and because of that, say, you think that, say, I should now sell that security, but by the time you go to sell the security, the price of the security has already fallen down. This is what, say, we understand is a kind of, say, the semi-strong form of market efficiency and strong form of market efficiency. Strong form of market efficiency means a market in which insider trading is highly punishable offense. Dear students, the insider trading means something like this. Suppose I am director of Reliance company. In the board meeting of the Reliance company, say a point which has been concluded or a point which has been discussed is that, say, we are going to issue bonus shares to the existing shareholders. Now this information is going to be like one of the point based on which I can earn super normal profit. However, the insider trading is highly punishable offense, because of which with this information I can make super normal profit, but I will not make. At the same time, I will not pass on this kind of information to anybody else. If at all there is a situation wherein, say, there is some like very secret information of the company which is going to be announced in the public later on, but during that time period you can make a gain with that information. But over here we understand that, so the insider trading is highly punishable offense, because of which you cannot make that gain. That is what we understand is a strong form of market efficiency. Dear students, weak form of market efficiency is the market that is called weak. Why? Because still this kind of information can be used for the purpose of making abnormal gain. So it is called the weak form of market efficiency. Semi-strong form of market efficiency is the market in which you can make gain, say, with this kind of information. That is the reason it is given a name as a semi-strong form of market efficiency. And strong form of market efficiency in which everybody has to take a risk, only in that case you can get a return. If you think that, say, with less risk I want to make a return, not possible. This is what, say, the efficient market hypothesis. Listen carefully. In order to test, that the market is in weak form of market efficiency, there are two types of tests. One is given a name as autocorrelation test, which is assigned a variable R, and next is called run test. That is what we understand is called T distribution test, normal probability distribution test. That is what we are going to learn. In order to test semi-strong form of market efficiency, there is a test called filter test. And as far as a strong form of market efficiency is concerned, to test that, there is no as such any model which is there. It is only the theory that we have. So in case of the weak form of market efficiency, what we are going to check? We are going to check that based on the past prices, can you predict the future prices? If yes, then the market is not in weak form of market efficiency. If at all based on the past, you cannot predict the future, then it is called weak form of market efficiency. Semi-strong form of market efficiency. It means that the return that you are able to get is based on the risk. Are you able to beat the market? If yes, then in that case the market is not in form of semi-strong form of market efficiency. Wherein we understand that the value of the alpha is very high. Alpha is like the return minus the required rate of return, mean return minus the required rate of return. If alpha value is very high, the market is not in weak, that is semi-strong form of market efficiency. Otherwise, it is in semi-strong form of market efficiency. For strong form, as I told you, that there is no test that we have. So these are the three numericals that we have. So far in institute examination, so the questions have been asked for autocorrelation test for once, and for run test it has been asked for once. That is the way, so that two times, so the questions have been asked from this. So write down heading efficient market hypothesis. EMH. In that write down, first point, as per this theory, market is efficient. Full stop. It is not possible to earn supernormal profit consistently. Second point, an investor will be able to earn return based on risk undertaken in the investment. Third, there are three forms of market efficiency. A. Weak form of market efficiency. B. Semi-strong form of market efficiency. C. Strong form of market efficiency. Fourth point, in weak form of market efficiency, comma, based on past prices, comma, future prices cannot be predicted. Full stop. In the trade on for the technical analysis, is not useful. Full stop. Prices change randomly. Fifth point, in order to prove weak form of market efficiency, comma, we have autocorrelation test, in bracket I am writing R, run test. Friends, how this run test and autocorrelation test work, that we are going to study in the subsequent portion. Next, semi-strong form of market efficiency, means all public information have been incorporated in price of security. full stop. Based on any favorable information, comma, if an investor purchases security, comma, price of security have already been increased, full stop. Based on any unfavorable information, comma, price have already fallen down, full stop. 7 point. Residual analysis will be conducted to check semi-strong form of market efficiency. Eighth, strong form of market efficiency means a market in which insider trading is highly punishable offense and anyone cannot use secret information to generate supernormal profit. Full stop. Next, in weak form of efficient market, comma, there is a possibility of using public information to generate supernormal profit, full stop. Further, insider trading is also possible, full stop. With paragraph breakdown, in semi-strong form of market efficiency, comma, supernormal profit is possible through insider trading, full stop. So why it is called weak form of market efficiency? Because these two things are possible. In semi-strong form of market efficiency, because insider trading information, that is that information can be used to generate supernormal profit.